Every breach starts as a risk someone decided wasn't worth worrying about. Now that we have established the purpose of GRC, it's time to dig into the first major component, that is risk. In banking, every system, every process, and every customer interaction carries some level of risk. The challenge isn't eliminating that risk entirely. That is impossible anyway. But understanding it well enough to make smart and informed decisions. In this module, we will break down how to think about risk in information security. What is it? How to measure it? And why likelihood and impact are the two levers that determine how seriously we take it. I'll share real banking cases where the risk was underestimated and the consequences were pretty severe, as well as examples where smart risk assessment prevented a disaster. By the end of this module, you will be able to look at a risk and see beyond the technical details. You will see how it affects operations, compliance, customer trust, and ultimately the bank's reputation. Now we come to one of the most important slides in the entire GRC journey, understanding risk. In a bank, risk comes in all shapes and sizes. There's a credit risk, then there's market risk, there is liquidity risk, all the usual suspects. But increasingly, cyber risk is right up there with the big boys and girls. GRC helps us assess what can go wrong, how likely is that to happen, and if it does happen, what is the impact. And here is the formula we always go back to. Risk equals to likelihood times impact. Let's take a real world example here. Say a core banking platform is vulnerable to a remote code execution bug. If that vulnerability is internet exposed and unpatched, the likelihood is high. While if the system processes millions in daily transactions, the impact is massive too. And this isn't just about IT anymore. This is operational and reputational risk. In Tesco Bank fraud of 2016, hackers exploited weak controls, affecting over 9,000 customers. What was the impact? 2.5 million pounds in fraud, Financial Conducting Authority fines, public scrutiny, and last but not the least, loss of trust. So in banking, assessing cybersecurity risk means aligning it with the existing enterprise risk taxonomies and making sure cyber threats are viewed with the same seriousness as financial ones. Next, we will look at how we measure impact and likelihood in more detail. Stay tuned. So now let's talk about impact, the damage a threat can do if it hits. In banks, the impact of a cyber event can span multiple dimensions. Let's talk about the financial ones. It, it relates to direct losses, frauds, and penalties. Then operational ones. Customers can't access funds, delayed settlements, reputational. Trust is shaken, and in banking, that is everything. Compliance, failure to report under GDPR or operational resilience rules. Strategic, long-term fallout that affects competitiveness. Let's make this real. In the Capital One year 2019 breach, the breach affected over 100 million records. While the technical fix was fast, the regulatory and reputational impact lingered for years. Now, depending on the size and complexity of the bank, the same event may be viewed very differently. £100,000 breach might cripple a fintech startup but barely register at a multinational like HSBC. That's why some assessments use quantitative values like annualized loss expectancy, the ALE, while others stick to qualitative scales. For example, high impact, low impact, medium impact, etc. And we can't ignore what kind of data is affected. An outage in the HR portal? Annoying, but survivable. Ransomware on your real-time payments infrastructure? That's a crisis. So impact analysis isn't just a checkbox. It's a business lens on cyber risk. Now let's talk about likelihood, the other half of the risk equation. In a bank, this isn't theoretical. Whether it's a phishing attack, a DDoS campaign, or a ransomware outbreak, some threats are just a matter of time. So how do we measure likelihood? We look at how likely is the threat to occur. How vulnerable are we if it does? Let's say you are evaluating ransomware risk. If your bank has outdated systems, no network segmentations, and no tested backup strategy, then yeah, that's almost certain on the likelihood scale. This is where banks rely on historical incidents, what happened internally, etc. Then threat intelligence from FS, ISAC, or NCSC, etc. Industry trends, example spikes in banking sectors or ATM malware. And of course, judgment from your risk and security team. A good example is the 2021 ransomware wave that hit multiple banks and insurance firms across Europe. Even those that weren't targeted still reassess their likelihood rating due to proximity and sector relevance. Remember, not all threats are created equal. A rogue trader scenario may be rare but devastating. Phishing is constant, but you may be hardened against it. We will soon combine likelihood and impact to build risk heat maps and drive treatment plans. Stay tuned.